In this video, we are going to look at the accounting for cash dividends. When we are dealing with dividends, there are three important dates. There is the date of declaration, the date of record, and the date of payment. On the date of declaration, the Board of Directors will announce that a dividend will be paid out of the company's profits. On the date of declaration, in the accounting, we need to record a liability to pay that dividend. The date of declaration, the declaration by the Board of Directors, puts a liability on the company to make the payment. On the date of record, there is no entry required. The only thing that occurs on the date of record is the shareholders who own the stock are recorded or identified. Those are the shareholders who will be paid the dividend. And finally, the third important date is the date of payment. That is the date that the liability that was recorded on the date of declaration is paid. For example, date of declaration. On January 19th, a $1 per share cash dividend is declared on ABC Company's 10,000 common shares outstanding. The dividend will be paid on March 19th to stockholders of record on February 19th. The date of declaration, the Board of Directors announces that a dividend will be paid. That means the company has a liability to pay that dividend. We will need to record that liability. We will credit the liability to increase it for the amount that will be paid. $1 will be paid per share, and currently there are 10,000 shares outstanding, which means those are the number of shares held outside of the company by shareholders. Total liability will be 10,000. The company will pay that dividend out of profits. Profits are recorded in retained earnings. Instead of directly taking it out of retained earnings, we will record it in another equity account called cash dividends. You can think of cash dividends as a contra equity account. By debiting cash dividends, it is increasing the balance in the cash dividend account. That increasing debit balance will offset the credit balance in retained earnings. Thus, by debiting cash dividends, increasing that account balance, we are decreasing retained earnings. Eventually, at the end of the accounting period in the closing process, that cash dividends account will be closed into retained earnings. The next date is the date of record. Recall that the date of declaration was January 19th. The date of record is February 19th. In the accounting department, no entry is required. There is nothing that affects the accounting books. The final date is the date of payment. January 19th was the date of declaration. February 19th identifies who owns the stock, the date of record. Finally, the payment is made on March 19th. That is the time that the liability that was recorded on the date of declaration is paid. We will simply debit the liability to decrease it and credit cash because this is a cash dividend and cash is being used to pay off that liability.